Hi, everybody. I'm Gary Brode from Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to hedge funds, family offices, high net worth individuals on a subscription basis. Our only goal is to help people get better returns in the equity markets. We like to contrast that with the sell side, which may have some sort of conflict in terms of trying to generate investment banking revenue. We're very excited today to be joined by somebody with the same business philosophy as we have. We're welcoming Jim Osman of The Edge. Jim founded The Edge in 2005, and they cover special situations, spin-offs, activist ideas. Like Deep Knowledge Investing, The Edge is only focused on helping their subscribers get better risk-adjusted returns. I will tell everyone listening to this, I personally have read their research. I've been to their conferences. They are dedicated, focused, and do an incredible job on the research side. Jim, I know you're directly involved with all of that. Welcome.
Thank you, Gary. I appreciate that. Nice intro. And yeah, listen, let me know what you need today, and hopefully we help the guys on this morning.
Terrific. Well, for the people who are not familiar with The Edge, why don't you tell us a little bit about the kinds of investments you guys cover?
Okay, yeah, sure. So I started The Edge back in 2005-06, just with a goal of, previous to that, I'd been running a hedge fund, and I'd been through all that kind of big bank stuff and all the rest of it, and all the boring stuff. What was interesting to me was there was a lack of research of special situations, spin-offs mainly out there, that could really be helpful, because these situations, and still today, just go along undercovered or not even covered. And you know what? There's been a prominent source of idea generation, not only idea generation, but also profitable idea generation, profitable investments. And I wanted to start something that would give investors, money managers, people like that, the ability to get involved in these corporate actions and make money out of them. So we started The Edge, and today what we do is we not only do that in spin-offs, we look at our own special situations, and we very heavily involved with activism as well, in actually forcing companies or providing the ideas to activist investors to force the companies to make change, again, for the good of the underlying investor into the stock.
Jim, we agree with you. It's a part of the world that's complicated and often not well covered. Let's talk a little bit about your security selection process. How do you guys decide what to recommend? What's the process you go through?
So there's a couple of things really for subscription models. One is the spin-offs. Now, spin-offs we cover publicly announced spin-off. You say, well, okay, great, I can find those anywhere. Well, you can and you can't. You know, but again, just going back to what I said earlier, to be able to actually monitor the situation is very, very difficult, to be honest. And you know, it's because they have no incentive. The management have no incentive for pushing the idea on you, just like an IPO. Contrast that to an IPO where, you know, I want you, Gary, as an investor, to pay up as high as you possibly can for me to sell you stock at the highest possible price, so I can make as much money and get as rich off you as I can, right? Contrast that to a spin-off where they want the price as low as possible, actually, because they want their stock options struck at the lowest point so they can turn around the stock and get the stock up. So you got two contrasting angles here of situations which sort of seem the same on the face of it. One's an IPO coming onto market, and other stocks coming on the market, but without any fanfare. So I mean, if you take that just as it is, then there is no, you know, fanfare. There is no roadshow, really. There is no puffing of the stock. So you don't get much information, is the long and short of it. And then you've got to find that information, you've got to analyze it, and then ultimately you've got to say, well, is this a good one or is this a bad one, right? So we've got spin-offs on one side. The other side, we have special situations. Now, what are they? They can be hard catalysts, or they can be soft catalysts, and they can form into anything, such as a restructuring, something like the Harley Davidson we done recently, where it was a total restructuring of management, where they turned themselves from an old, you know, long-haired, bearded, fat guy on a motorcycle to a punchy young guy on an electric motorcycle, and you can't buy one at the moment, right? So, you know, and the stock has benefited from it. So we go through different types of catalysts on that, and we pick those ourselves. And to answer your question, we probably produced around 50, 60 ideas a year, but that's probably too many for most people. So we narrow it down to maybe 20 and maybe 15 high conviction. But if we cover everything, then people see things that we don't sometimes, and that's good. And hopefully with all those ideas, they're going to make some money and a return.
Sounds good. Let's move to the thing that people are really interested in, which are specific actionable ideas that you like today. Here we are on video discussing this. This video will be posted to our YouTube channel, to LinkedIn, to the Deep Knowledge Investing website. Obviously, video is the direction that people want to absorb information these days. I know Vimeo is one of your favorite ideas right now. Let's talk about that. Let's just start with what Vimeo's revenue model is for people who aren't familiar with the business.
Yeah, absolutely. So Vimeo, just to give you the background now, obviously we look at spin-offs. We'll spin off a company called IAC. Now, IAC is one of those companies where you may have heard of, you may not have heard of. But if I mention stocks like Expedia, if I mention stocks like Match.com, things like that, you're going to go, well, yeah, of course I know those. They, again, were all spun off of IAC. Now, IAC is run by a guy called Barry Diller. Now, Barry Diller is a very high-profile CEO. Again, you may have heard of him, you may have not, but he's a huge value creator. Now, what he did recently, and you can actually Google this. There's a little bit of research on there. I write for Forbes on the side. If you type Jim Osman Forbes, you'll see one of the ones on Vimeo. But my point is, what he did is he spun off Vimeo quite recently. Now, Vimeo is a single turnkey solution to create, collaborate, and communicate with video. Now, why is that important? I mean, over the last year, I mean, with people being, you know, and I've said this again and again over the past couple of years, actually, that people are just becoming more insulated. I mean, people do not want to speak to people. People want to sit at home. Young people, particularly, just want to click it, pull on a click, and video has become a real medium for communication. I mean, look at it here today, right? You just log on in your pajamas and watch me mutter on about anything I want, but and you can't be seen. So there's a lot of advantage to the video and video communication, and what Vimeo provides is just that. But it's a one-stop shop, and it earns its revenue through software as a service, SaaS business model, selling subscriptions to cloud-based software on an annual or monthly basis. It employs a freemium pricing strategy, offering free membership, access to video tools alongside paid subscription plans, and advanced video capabilities. And here's the interesting point: as of September, the end of September last year, over 95% of subscribers purchased plans without ever speaking to customer support or going through a salesperson. So you can see where this is going, and the world is going really in terms of the video. They have a couple of subscription plans, self-serve subscription plans, meaning users can sign up directly through the website or app and pay subscription fees. They range from $7 a month to $900, and the features depending on the plan type. And they have enterprise subscription plans, providing additional features beyond those mentioned, plus account management service levels and all the rest of it. And these contracts can range to thousands to hundreds of thousands of dollars a year.
So with huge contracts like that, who are Vimeo's content creators and how are they paid? How is the business model different from maybe the standard YouTube kind of model?
Well, it's an interesting question because, you know, people say to me, well, hold on a second, they're just going to come in and they're going to get crushed by YouTube and all the rest of it. Well, this is something slightly different. The content creators are yes, they're the normal people that might use YouTube. They're also filmmakers as well. And the users can sell their subscribers through Vimeo OTT and Vimeo on demand, and they're free models of Vimeo on demand, subscription video on demand, transactional video, and ad-supported video. So with Vimeo, you're getting a lot more flexibility than you do with YouTube. YouTube runs a monetization program, which is the YouTube Partner Program, some of you might know. And lets creators earn revenue from their ads shown on their YouTube video. But the creators must hit 10,000 lifetime views in their channel to turn on monetization. And comparatively, Vimeo is an ad-free platform, So that's allowing users such as professional filmmakers, which are seeing people putting their movies on there, to directly sell content. So viewers get full access and provides autonomy over revenue generation. So you can see how this is building up a little bit different to a YouTube style video streaming. It's a lot more flexible, gives people a lot more autonomy. And you know what? It's a one-stop shop. They can edit, they can host, they can monetize, distribute, put it on different platforms, whereas YouTube is a kind of bit clunky, a bit kind of one stop, there it is. So Vimeo has an advantage over these competitors with a one-stop shop service, and the growing subscriber base assures you know, some healthy growth and business revenue growth. So an important competitive edge Vimeo holds is the ability to facilitate distribution across various platforms as well as websites, apps, and marketplaces. It doesn't only rely on its own website for content viewing. So this is very interesting to us, where we've got a new player in the market. It's also quite cool, you know. Vimeo is quite cool as well, right? You know, there's always a cool kid on the block, and I think Vimeo could be one of those.
Sounds good. It sounds like it's a better platform for people doing long form content, expensive content, the kind of thing where they want to get paid directly rather than hoping you get ad click revenue. Does that make sense?
Yeah, absolutely. It's just like a different option, you know, to the YouTube kind of old stuff. So very flexible, nice, cheap, cool. You know, and we think it's a good company as well, and it's got great management as well, and you know, and it's cheap fundamentally.
Sounds good. By the way, before I go on to the next question, Jim, I just want to tell people who are listening, if you have any questions that you want Jim to answer, feel free to use the chat function and send a message to Jordan, and he'll pass it on to me, and we'll make sure you guys get a say in what we talk about. Jim, back to you. How are you guys valuing Vimeo? What's the current valuation? What's your price target? How are you getting there?
So these are always very interesting and always very debatable, Gary, when companies spin off, because people have different views, right? I mean, these are, you know, you talk about growth companies, you talk about value companies. It's almost the same thing to me these days, right? But this is a pure, I would say, it's fundamentally cheap, and it's also a good growth company. So, you know, I don't know what bucket we put that in, but certainly on a numbers basis, when companies, and those of you who are not so familiar with spin-offs, when companies are spun off onto the market, you know, they have no following. They have no following probably for 30 to 90 days afterwards, unless they're, you know, huge spin-offs. And this one isn't a huge spin-off, but so it's debatable how people want to value this. But how we valued it, it's just started positive, posting positive EBITDA numbers, and we're valued on the basis of full year 22 EV divided by revenues multiple. So what have we got? We got we're putting a 10% premium over the average peer group. We arrived on a multiple of 17 times, and we have an equity valuation around $9.5 billion, around $66 a share. So that's around an upside around 40%. So, you know, without going too many numbers, that's kind of how we valued it. That's right off the back. So we see a company with an unusual company, unusual spin-off actually, who doesn't carry any debt and also has good free cash flow. So this is, you know, one of the classic, maybe too small for a Buffett, but one of these classic stocks, which is a good business. It's undervalued. It's good cash flow. It's no debt. Well, what more do you want at these levels?
Just out of curiosity, when you talked about 17 times, are you using that as a multiple of revenue or EBITDA?
Using that as a multiple of revenue.
Okay, gotcha. But they're cash flow positive now?
Yeah, they are. Yeah.
That's interesting. So they've got time to build it out. What's the top line growth look like here?
I'm not sure. I don't have those figures desperately in front of me. I can find out for you if people have got specific questions on the fundamentals. I don't have all the numbers in me, but I'll. I mean, it's an early company. It's got cash. I don't think they're not going to run out of money anytime soon. And they're going quite aggressively out there. And the CEO's come out very early on to say they would be looking to make some acquisitions to build up the company as well. So, I mean, early days at the moment. I mean, we're not talking any sort of mature, huge company here, but the prospects are very good.
Gotcha. So, what do you think the street is missing here? I mean, if you think it's 40% undervalued, why, what is everyone else looking at that the market price is so cheap right now? And understood that, like you said, when you have a spinoff, the incentive is to price it low and to not have a ton of attention. But people will be looking at the same growth you are. What are you seeing that everyone else is missing?
Well, here's the thing. Again, we play on the idea that a lot of these spin-offs are just undercovered, right? People just haven't seen them. I mean, how many of the guys on today, could realistically put their hands up and go, "Yeah, Vimeo. I knew that was a spin-off. I knew that was on the market. Yeah, I like to look at that." I don't think they would. And I was at a conference a couple of weeks ago, and there's a lot of smaller investors, and I said to them, "Well," and they said, "Well, Jimmy, I have that. I just sold it. I didn't know what it was. It just appeared on my account, and I sold it, right?" And even just on a side note, because I want to tell the story as well. One of the guys, he said, "Jim, I've never looked at spin-offs. This is revelatory. I got Chipotle spin-off of McDonald's back in 2005. He remembers this. He come up to me and he said, "You know what? I got it at 22. I just got it. I didn't know. So I thought Chipotle. It went to 44. I thought I doubled my money and I sold it. Today it's at 1,300. So, it's understanding really what these companies are worth. Now, if you have a free stock on your, and Vimeo, in fact, got sold off. And I'll come back to your question in a second, but I just want to give it a little bit more color to it. Vimeo got sold off, hit the market about 50, got sold down to 40. We recommended investors to buy at 40. It's up at 47, 48, actually reached 52 the other week. You got 30, 35% out of it already, So what are they missing? Well, what did anyone miss? They missed the fact that it was on the market, it got sold off because people didn't know what it was. And now they're maybe starting to think about, well, what's this stock? So you can get a good uplift on some of these very early on. Just the fact that you say this world is efficient, it's very inefficient in spin-offs. So yeah, that's the first thing. So just the fact that people don't really know that it's been spun off. And remember, you get spin-off shares whether you like them or not. You have no option. Okay, you own IAC, you get them whether you like it or not. You see them on your account the next day. You're someone who doesn't take a note of this. What are you going to do? You essentially got a free stock. Well, I'll take that money, right? So that's what we try and do. We try and add the benefit of saying, when you get this is the valuation, you should hold it, or actually it's become cheap all of a sudden because of an anomaly of people selling, and you should get in. So that's the first thing. Second thing is, you got this one-stop shop nature for all businesses, and video editing, hosting, monetizing, and distribution, right? There's not much out there like that. So, you got a good company which is different, and I think that again, people are not seeing that. Provides far more independence to content creators and users, and they're able to monetize and distribute their video content. It's a great system to do that. And it's an ad-free, balanced experience. Unlike social media platforms, Vimeo offers free users. Free Vimeo player enables subscriptions to fully customized video experience, and complete control of their content. And people want complete control. And in this world where people are putting ads on your, you don't know what ads. In fact, you don't know what ads YouTube would put you on, but they could put you ads on anything. So you have no control of that either. So enabling people to build a fully branded video channels is a good thing, and I just think that people maybe have not even thought about that for the minute.
Jim, I'll tell you what I love about your answer. At both Silver Arrow and Deep Knowledge Investing, one of the situations that we always look for are ones where people are engaging in non-discretionary selling. When people are selling for no particular reason, or they can't actually look at the situation, the valuation, it's just a non-discretionary sale. We want to be on the other side of that.
Well, I mean, on this one, there's a few ways to look at that, and what we try and do here at the Edge is we look at stocks that come out of indices. Now, this one didn't particularly come out of an index, but some of these smaller spin-offs will just get slammed, or Ganon, just run out of Merck, got absolutely slammed by every single fund out there in terms of selling. Now, we can try and quantify that, and we can say, well, hold on, we can say there's 60 million worth of shares got to be sold. Okay, we're coming to 58 million. Okay, so it's got slammed. The valuations come down, maybe it's the start of a point to get in. So, it can hurt you a lot, really, if you don't know this stuff. And again, if as an investor, if you see, and even if any sort of investor, big or small, if you see this stock on your screen, you've just got it on your account, you don't know what it is. It rarely appears on institutional accounts for like a few weeks or a month, and then they see it getting down, they're just going to sell it. And this is very, very interesting. Again, inefficient markets in terms of spin-offs.
Got it. All right. So why don't we move on to another of your favorite ideas? Know that you guys like Dun and Bradstreet a lot. Let's talk about what the business model is there. We know they provide data analytics for the people listening in who aren't familiar with the company. Let's just talk a little bit about what Dun and Bradstreet does and what they provide their customers.
Yeah, sure. So Dun & Bradstreet is one of our special situations. Now, we look very closely at, we pick out special situations, whatever they may be. This one's more of a restructuring model. It's more of an insider buy model. Now, Dun & Bradstreet is a very, very familiar name to everyone. It's a great brand, actually. It's existed since 1933. And it's been a long-established data provider with historically strong competitive position in private company content. And it's best known for its DUNS number, which you might be familiar with, which is essentially a corporate social security number in the US. I mean, you have to have a DUNS number to trade with the government. And it allows D&B to establish linkages between corporate entities and provides a paydex score. So considered a FICO score for businesses. So what we got is a solid company that was taken off the market a few years ago by private equity, brought back onto the market last year in kind of all the noise, and so you might not have noticed it. And it was brought back on by private equity, but with a new management, which we'll talk about in a second. Now, the company operates in two segments: finance and risks, about 60% of the revenue, and sales and marketing is about 40% of the revenue. So finance and risk provides clients a subscription-based platform offering real-time access to information leveraging the data set. And the sales and marketing helps businesses discover new revenue opportunities and data analytics. And in this world of, data and data analytics, my argument here, which isn't expressed so much in the research, but I think we could have made a better effort actually having a look at it now with new information. Now, this move to people used to spending, last year people were spending a lot of money. Companies were spending a lot of money. They felt rich. Let's face it, no one really had a bad time last year. If you were out of work, you were getting paid. And with companies, it's been the same. They've been spending a lot. They're going to find that's going to come to a halt very soon. Inflation is coming. This companies checking other companies is going to become very, very in vogue, I think, more and more. And stuff like companies like Dun & Bradstreet are becoming more important. So that's just a little side note, really, to what they do, because they've kind of been a bit of a sleeping giant. They've been a bit going sideways, a bit boring. But now with this coming back onto the market, it could be interesting. And there's a few players in the space. Equifax is one, if you want to compare it, Moody's, and Zoom Info. So there's a couple of stocks that are a little bit similar to this, but that's kind of the basis of the business model.
Do they have any kind of competitive moat, or can other companies provide comparable data?
Not so much, I say, competitive moat really, but they do have, data on hundreds of millions of companies. And they're very aggressive in that fact. And it's one of those companies where, you just is a go-to company. You know the name, you can trust it. And it's just one of those companies where you could use, and it wouldn't be a worst company to use to find out that stuff. And with the DUNS number, it's kind of got a brand in itself.
Okay, got it. Now, I know from our prior discussion on the name that a key element of your thesis is insider buying. Who's buying what, how much, what's going on with that?
So this is very interesting for us. So we monitor insider buying very, very closely. And not only, it's not about people buying, just companies buying, executives buying stocks. It's about their background, their history, how much they own, whether they're any good or not buying their stock. You'd be surprised. A lot of investors are just not very good at buying their own stock. And so we try and identify the key insiders, the smart insiders. And what we realized here was one of the CEO, actually, Anthony Jabor, was also a major investor of Black Knight Financial, was also a spin-off. BKI is the ticker. And he had a particularly strong record of insider buys. I think he made sort of 70 or 80% on his last buy. Now, when someone comes in like that and they're buying, and I'm talking about not stock options, I'm talking about significant buying out their own pocket. And he bought at 27, and then he bought at 26, and he bought 23, bought 20 and 21, just to stop drifting down. And they're coming out with good earnings. You kind of think that, okay, if the CEO is putting money in his own pocket, maybe $5 to $7 million of his own money, and then he believes in the company, and he's got a track record of doing this. So that piques our interest in these sort of stocks where they're drifting down for no reason. The earnings are okay, and there's sort of a turnaround in the process. And we had him, and also the CFO Brian Hipshaw, also buying shares in the open market, and basically those two guys are key insiders, as we call them, and significant in their buying. So that piqued our interest. So along with that, along with the restructuring, along with the new kind of stock on the market, again, this is one of those stocks where you've probably heard of the name. You've probably heard of Dunn & Bradstreet. Did you know it got put onto the market last year? Probably not. So we're looking for, not so much looking at the fundamentals totally, which they are cheap, but also looking at the catalyst which could be involved to propel this higher in the future.
Right. And the old saying when it comes to insider buying, there are lots of reasons why an insider might sell, but only one reason they buy. And
absolutely.
It's a great old expression. You touched on the fundamentals. What's your view on that? What do you expect from the company in terms of short or long-term results? Are you looking for revenue growth, margin expansion, free cash flow? What's the right way to follow the company?
Yeah, so the full year revenue is at 762 million on ZI stock, and it's lower than the DNB's S&M segment revenues. And having said this, the ZI offers a higher revenue growth profile, but over the next couple of years, we expect to catch up on DNB, what they're doing. We expect to chase down the revenue growth and matching the peers. So we think there's an uplift in that. We also expect them to do some good things with the management. We're under private equity own them. We got managers on that are really pushing and pushed before in Black Knight Financial as well. So we've got a good board assembled now, whereas this was kind of a stale stock before. We got a cheap stock which the management are looking to bridge that gap with the peers. So we're basing our target prices around $30, which is a 1 year's price target, implying upside around 43% from the current share price, around 21 and a half. And we can go through some valuations if you want there, but that's where we're expecting the uplift. We believe it's cheap to its peers, and also there's a potential separation in the S&M business. Seems an excellent way to unlock value at DNB. It's first time it's ever mentioned, first time anyone's ever mentioned that, but we could separate the two businesses into a spin-off as well. So there's potential for them to do that. There's also potential for activists to go in and do that as well. So cheap stock you got, cheap to peers, potential for a spin-off, and good management. But that's how we're valuing it.
Got it. Okay. So Jim, I know we're running short on time here, and you're going to have a plane to catch. Last question for you. You did talk about valuation metrics. How are you getting to your price target? And besides the fact that it's kind of a sleepy name that people didn't realize it IPO'd, what are people missing on this, and how should they be valuing it?
Okay, and just so you know, if people want to check in Buzz or you or whatever, then we can show them a little bit more on the. We talk through the numbers with the analyst, or we can go deeper on these. But we value DNB for the finance and risk segment, full year 22 EV by EBITDA 15.2 at 10% discount to the peer average of 17. Sales and marketing segment 23 times, 50% discount to its closest peers at ZI of 46 times. We've taken a 10% and 50% discount respectively to each of the segment based on lower single growth poll of DNB versus peers. So we've conservatively valued this really. Any sort of uplift here or any sort of value creation, even the potential separation, could use a huge move upwards. And with the insider buying quite aggressively, of key insiders, it makes a good case.
Got it. Makes perfect sense. All right. Well, everyone, we are here with Jim Osman of The Edge. As Deep Knowledge Investing is a believer in independent research and focusing on getting client returns, the people at The Edge are doing the exact same thing. We completely support them. For anyone interested in more of the kind of work that Jim and The Edge is doing, or if you're interested in subscribing, reach out to me at ir@deepknowledgeinvesting.com. We will put you directly in touch with people at The Edge who can help you. Jim, thanks so much for your insight and for spending this time with us today.
Thank you very much, and appreciate your time.